What the just happened? Can a stock really go up by 2,500% in less than a month? Hi everyone, welcome back to the channel. If you're new here, I'm PPE and this is the Peso Pro episodes where we talk about money management tips and peso tricks. If you're looking for information on personal finance, you've come to the right place. Today, we're gonna shift gears a little bit and we're gonna talk about something that is literally taking everyone by storm. If you've been paying attention to stock news or even just mainstream media over the past few days, you probably heard about GameStop, the gaming company that actually sells consoles and video games to the US in their brick and mortar stores over the past several decades. Well, if you haven't heard the news, this stock just having been traded at about $18 per share just this January 1st is now being traded at about 300 to 400 plus dollars per share. Talk about monumental astronomic growth. That's almost 25 times its value when it started the year 2021. But what really did change with GameStop, and is there anything that happened across the last few weeks that's causing this major change in value, and is this sustainable? Today I decided to cover GameStop not because it's still the hottest thing in town, but because even if you're not a day trader or even if you're just new to investing, there are a lot of lessons to be learned in what's happening currently in the US. This saga between retail investors and the hedge fund companies are still at large and in play. As of the filming of this video, I personally don't know what will happen to GameStop, but we can take a look back as to what happened in the past maybe 4 to 6 weeks driving up to the price and what's currently happening in the market today. Before we start with the hardcore information and lingo, let's establish first the characters in this story. Now, whoever you tag as a villain or a hero in this story is totally up to you. But essentially, there are two big players in this drama that we're going to unfold in this video. The first ones are typical retail investors like you and me who invest in stocks in our trading capacity. However, in this story, we are all banded together by a Reddit channel called Wall Street Bets. Technically, Wall Street Bet is dominated by young day traders who are trying to find the next bet in Wall Street to go against short traders and try to bet against very devalued stock and trying to earn a profit from it. In just a few weeks, Wall Street Bet's membership base in Reddit has grown to almost 6 million Redditors today. This means that all of these day traders are clinging on to this Reddit channel and is being coordinated by its moderators to make the next stock play. What caught the attention of Wall Street Bets recently are struggling companies like GameStop, but not limited to that. They've also called out companies like Macy's, BlackBerry, Bed Bath & Beyond, and even Nokia. These companies are nowhere near their performing prime, but Wall Street Bets is betting that this can make a profit for them. Cue in the next character. The second characters are the hedge funds or companies who manage funds and invest them in the stock market. These funds can manage significant amounts of money, and in this case, the one in the middle of all of this is Melvin Capital. These hedge funds can also be short sellers, or technically, people who place bets on a stock that they expect to lose. Meaning, different to the traditional approach of when you place money in a stock, you wait for its value to go up, these people actually expect the other way. They put a bet that the company's stock will actually go down in value and they can profit for it. More on short selling in a while. In a short summary, Wall Street Bet's founder or moderators actually found from regulatory filings that Melvin Capital and other hedge funds have significant amount of short positions in GameStop and other companies. They believe that with the significant amount of short positions that these companies have, that these companies are actually manipulating the price of GameStop to go down because they can get a lot of profit from this. If you think about it, however, GameStop is an old brick and mortar store who has very, very little digital presence and is selling video games still in their traditional stores. With the shift to digital commerce and the bigger players all moving into a somewhat e-commerce platform, and with the pandemic taking place, the company is actually expected to lose money this year and probably the next year. All of this momentum did not start from nowhere. On Jan 11th, they actually announced that they are getting a few members of the board to join, including Ryan Cohen, a senior executive at Chewy who has a very, very good digital platform, signaling that GameStop can actually try and build back its base by becoming a more digital company. On the same day, stocks rose by 13%. However, this is far from what we've seen in the past few weeks. Day after day, GameStop has increased from 29% to 40% to 50%, and in some trading days, they actually doubled the value overnight. This because Redditors have banded together and actually placed retail capital money into the stock, driving the price up. If you just look at GameStop stock price just last January 2020, that would have been only at about a $4 range. Now it's trading at about $400, which is 100 times what it was just under a year ago. If you're probably thinking if this can happen anytime as long as enough people band together, then why is it only happening now? In recent years, trading and investing has become more democratized, and in the US, more and more platforms like Webull or even Robinhood has been entering the scene and is making investing much more accessible to traders with low capital as long as they have an access to a smartphone and the internet. Okay, if you're still with me and if you're thinking, okay, if a group or millions of people put whatever money they have into this common goal to buy this stock and drive the price up, isn't that necessarily good for the hedge fund? And that's, I know, a bit confusing because in the Philippines, we actually don't have the option to do short selling. The traditional knowledge of what we know in investing and trading is that you buy low and you sell high. In this case, you're really just gunning for the traditional profit from capital appreciation. Meaning, if you buy a stock at 10 pesos, you expect that stock to go to 20 pesos, you pocket difference minus fees. However, in short selling, that's actually quite the inverse. In short selling, you're actually placing a bet that the stock price will go down. Let me explain. In a short sale, there are actually three big parties. One is you have a broker who actually owns the company shares or has an inventory of those shares. Then you have a short seller, in this case, Melvin Capital, and you have the market, which is basically everyone who buys and sells stocks. What happens is the short seller actually enters into a contract with the broker that they will borrow these shares so that they can sell it at the current market price. The short seller typically pays a fee or an interest to the broker for borrowing the shares. Think of it as something like a loan. Now, having the shares in their possession, short sellers will actually sell at the current market price. Remember, short sellers think that the stock's value will actually go down. Once they have possession of those shares, they sell it at the current market price. Just remember, short sellers believe that the stock price will go down. Let's say, as anticipated, the stock price does go down. So what they do is they go back into the market and actually buy the same number of shares back at a lower price. They pocket the difference and return the shares back to the broker. The deal is done. One thing you can note in this transaction is that it's extremely risky. What if the stock price actually does go up and never goes down, and it just keeps going up, and up? Short sellers would typically buy back shares at the lowest amount possible so that they can cut their losses. Remember, the shares they sold were never their shares of their own. They were just borrowed shares, and all these borrowed shares need to be returned at some point. What they would do, once they have bought the new shares, they would cut their losses and give it back to the broker, but then it's gonna be devastating to the fund. Now you can probably follow what's happening in the market. Melvin Capital or hedge funds in general did buy short positions to borrow shares from a broker. they were thinking that the stock price would go down, so they entered into this bet. What Wall Street bets, Redditors, are doing is that they are actually buying and buying and buying the share. In a typical market, this company isn't doing very well, so why would retail investors actually put in money, which is contrary to what the hedge funds were expecting. What this does is it actually drives the price up, and some short sellers actually will try to buy some of these stocks at the lowest possible cost so that they can hedge their position. What happens in this push and pull of the market is that it's driving the price of the stock abnormally high. And this is what is catching the attention of everyone. People are coming in on it because if you properly timed your entry right, and if there is still some upside to the stock price, you can probably earn several multiple times the money you put in. Take this from a friend of a friend that put in $3,000 just about last December and has seen significant 1,000+% growth over his portfolio. Talk about a good deal. But isn't this all just a bubble that's waiting to burst? Well, it definitely is. As you can see, as all of the short positions get sold off eventually, what's gonna be left is everyone who has a stock in Gamestop. And the reality is, the value of this company is far from $400 or $300 or maybe even $100 because it was just trading at about $20 before this whole fiasco. So is it a bubble that's waiting to pop, or is it an infinite money machine that may just keep going and earn us all millions and get us into retirement very quickly? Well, this kind of trading is bound to stop. If you were to look at what happened to Volkswagen in 2008, the same short squeeze phenomenon, which is essentially when short sellers are forced to buy more stocks, the price astronomically goes up because there's even more and more and more demand. If you can see the chart, the Volkswagen thing exactly happened the way that Wall Street bets expects this stock to surge. At some point in time, all of this has to go away and it has to normalize back. The key into this momentum trading is for you to know when to exit properly. But the thing is, nobody really knows. Is it gonna be $500? Is it gonna be $700? $1,000? Or even more? Some Redditors say $5,000 is a real possibility. For all intents and purposes, we never really truly know, which sort of underlines the lessons that we can learn from what's happening in the market today. Here are 4 lessons that you can probably take away from this once-in-a-generation experience. 1, it's important to understand that technically nothing has changed in the value of GameStop. It remains to be the company that is beleaguered with its brick and mortar stores doing traditional business. And yes, while they have 3 new board members on board to try to digitalize the company, it's still far from a valuation of about 25 times of what it was. At the end of all the hype, the company is expected to return back to its normalcy and probably will trade at or about around the price it was trading before all of this manipulation in the market. So while the market volume and the amount that is being pumped into the market is abnormally crazy high, it's never a good gauge to see a company as something to invest in the long term if the fundamentals are not right. Conversely, if you see all of the stable, well-positioned companies over the past few days, even with all of this volatility, their share prices have remained relatively stable and are performing as expected. Which one can argue, if you are trying to invest for the future and long term, those are probably more stocks where you can probably sleep soundly at night before you hit the bed. The second lesson is all about volatility, and when we talked about investments and the different types, stocks are very risky and can also be very high reward but also can be extremely very costly. I'll link to that video where we talk about different kinds of investments and the risks profile attached to them. When we talk about volatility, we talk about big surges of price in a short period of time. In GameStop, however, we've seen that in just a single trading day. When the market opened last January 28th, it actually started at about $265 per share and ended up rocketing to about $480 and then just crashed down to about $120 middle of the day and end up in the low 100s by end of trading day. Talk about a roller coaster ride with multiple swirls and hoops. when you invest in stocks, you never know what you're gonna get yourself into. So if you try to put in money in the long term, I strongly suggest that you take a look at the stable stocks and build a portfolio against a different set of industries so that you hedge against different factors of what can happen to the world. Or you can employ the help of mutual funds that actually invest in some indices that follow the market performance as a whole and not just one company. The third lesson is all about momentum investing, which is basically just riding trends to try to find a quick profit. Now, for all intents and purposes, this can be an investing strategy for some, but it requires a lot of due diligence, education, and a whole lot of luck. Think about this as probably having an investment strategy of going to the casino every day and trying to bet a certain amount thinking that you would win probably 1 in 100 times and you will win big enough so that you will have enough for retirement. While some people have earned a lot of money in this, I don't advocate you putting your life savings into something so volatile that no one can really truly predict. If you really want to join in on the hype, I highly suggest that you do this in minimal quantities and really take a step back and assess as to how much money you're willing to put in and be able to live if you're losing all of that money, because you may as well just lose all of that in a snap of a finger. The last lesson is all about value investing and investing for the long term. What millionaires will generally tell you is that you don't build wealth over time by looking for the next penny stock and betting your life savings on it. What you would probably hear as advice is the less sexy advice of disciplined, consistent, and regular investing over the long term on stable companies that will probably give you the return over the several years that you're investing. They would also tell you that investing early is of key importance because compounding interest is the magic of investments. So that's what's happening to GameStop. Redditors and hedge fund managers are in an all-out assault. And just in the last 24 hours, we've seen Wall Street Bets Reddit grow to about 6 million members and continuously growing, with other countries putting in more money into the system so that they can beat hedge funds. You've also probably seen hedge funds try to take back control by actually influencing, or not even influencing, outright banning of buying GameStop shares in key platforms like Robinhood and other platforms as well. For the Philippines, if you're using eToro, you've probably seen many halts in the market trades last night where you cannot buy GameStop shares anymore. In one announcement, eToro said that you can only close positions, meaning sell stocks rather than buy more GameStop. Is this market manipulation? Is there a larger force in play? Is going to be the question over the next few weeks, with several top-notch celebrities, icons, and even politicians in the US chiming in. A Senate inquiry is already in play and a class action suit has been filed against Robinhood for the events of Thursday. So whatever happens to this saga, only time can tell. Whether Redditors band up in several more millions and actually take down hedge funds and take money for themselves, or hedge funds finding a way to get out of this mess that they're currently in, we never can really truly tell. But for us as retail investors and investors trying to learn our way, the lessons we learn are more valuable than anything that we can take away from this experience. What's sure though is if you like this video, give it a thumbs up, and if you want to learn more and build your knowledge about personal finance or investments in general, please feel free to hit the subscribe button. It's free and you get videos from me every week. I try to upload videos twice, and hopefully this helps. I'll see you on the next one.